continue higher. My question is, what is Cononomics going to do? He's got 32% of the vote, Tom. Will he emulate Abenomics and drive equities higher to close the gap? Good morning.
Good morning, Manus. Well, you pointed to this is the important part of it. It's the fact that he is a far more popular candidate, at least at this point, combined with the fact that the economic pressures remain on Japan, of course, around the pandemic. It continues, and there is as yet no clear plan for how they're going to exit that. That is building into the view there's going to be more fiscal support, Manus.
Yes, Jacinda Ardern on the platform this morning, Tom, talking about incremental adjustments in New Zealand. I think it's going to put a bit more pressure on Japan. One other thing from Martin Malone, and he talks about it's not a boomer market. I'm not a boomer, but I thought I'd reflect that. In other words, stocks are 135% of GDP. In 1990, Tom, the warning sign was 140%, but it's a different market. It's tech. It's not all housing. It's not all finance, is it?
Oh, that's right. It has reformed this market in terms of corporate governance as well. Many would point to changes there, positive changes when it comes to corporate governance, allowing more of those foreign flows into the Japanese market. And that is the sum from some analysts now that you're going to get a relatively stable yen. That's going to continue, maybe some strength in the Japanese currency. So the fund flows are one to watch as well. Those foreign flows into Japanese equities on the back of what investors seem to see as optimism around this political change. Okay, we'll check in on the markets.
On the top of your board, yeah.
Yeah, absolutely, because of course we're seeing gains, as you say, close to 2% now on the Nikkei. Those 30-year highs above that now across these Japanese markets. The Asian markets, as a result of what we're seeing in Japan, are broadly positive this morning. China, by the way, mainland markets also higher, despite some regulatory changes there and a focus on the financial sector. The futures, of course, it's Labor Day in the US, but futures just essentially flat looking to the US. Aluminium higher on the back of that story out of Guinea and a military takeover of that government. Concerns about the supply of bauxite.
Yep, certainly supply is going to be tight though, Tom. We're going to dig into that in just a moment. So what does it mean for markets? He's been listening in, Tim Graff, he's been listening to my pronunciation of aluminium versus aluminum. He's the head of EMEA Macro at Strategy at State Street. Tim Graff, good morning. Welcome to the show. Here you go. Are you a buyer and a believer? If it is Kono, and Tom and I can debate that, we don't know. But the market is betting it's going to be Kono. If you have to position for Kononomics, do you want to be longer of equity and shorter of yen as a position into a repricing?
I think that's probably sensible. I mean, and not even just for the political reasons. Japan's been a region we've liked for a little while, simply because you're still in what we see as an industrial upswing, where exporters in particular have that ability to benefit from it. We see the yen is cheap and not probably going anywhere. So again, adding to that appeal of Japanese exporters and again, those industrial companies that make up such a large component of indices. And so I wouldn't be the least bit surprised if Japan continues to perform well, despite already being, as you mentioned, at 30-year highs.
Tim, do you expect to see a tick up in those foreign flows into the Japanese market on the back of these political tailwinds?
Probably. I mean, it might be a last push. I would say maybe not a last push, but Japan has been a popular view for a lot of the reasons I've just laid out over the last several months, most of this year. Those cyclical tailwinds it has, a cheap currency, etc. If this adds to that story, and if he does assume the mantle, then I would expect that to continue, just given it does seem the prospect for a little bit more expansionary mindset a la Abenomics might well propel those flows in. But I will say it has been a story that's already kind of been out there. So I do wonder if it's getting a little bit full. But again, the valuation framework, particularly on the currency side, I think supports the view.
Okay, Mr. Graff, join the narrative. Everybody else has had their spin on whether taper will be delayed until later in the year, maybe Friday. It was a big miss on Friday, wasn't it? 235 is what we penciled in on the payrolls. We missed, 235 is what we got. We missed by 500,000. So that was well short of what the market had anticipated. Let's listen to the other voices, then we'll add yours.
This was a materially lower number.
Did we report? First read is definitely this has some Delta variant on it.
This is the long game right now coming out of a worldwide pandemic.
There's one huge red flag for me in this payrolls report.
The hospitality number and the restaurant number.
0 jobs were created in leisure hospitality.
We had almost zero gain this month in that area.
You'll get some bounce back here in September.
The market's looking through this and seeing, hey, this is temporary.
Tapering is still very much on the table.
The Fed is going to taper.
The market is now pushing back any sort of Fed taper announcement to November, maybe December.
They don't need to rush into it. And the most important thing not to lose sight of here is the emphasis that tapering is not tightening.
Tim, what stood out for you then? You saw some positives essentially in this jobs report.
Yeah, I think the comment that was made just in that segment there, that they don't need to rush it. That's the thing that stood out for me about this report. It wasn't a good report, but it gives them flexibility, which is, it does feel as though they were talking themselves into this taper, with the more hawkish members being much more aggressive. And the inflation data, look, and last month's payroll report, or the previous month's payroll report, supporting some move towards normalization. This gives them flexibility. At the same time, I think you can look at some of the measures of underemployment, the 6 rate falling as much as it has, as being encouraging. There were gains made in workers with less than a high school diploma, those with just a high school diploma, all of which addresses or gets you a little bit closer to the maximum employment target that the Fed is talking about. And so on the headline, yes, it was a bad report. And the wage gains we saw were mostly due to compositional effects. But A, it gives them flexibility and they don't need to rush things, which is great if you're the Fed. And B, there are enough silver linings to this in those measures of underemployment that I think you can take away, at least for them, some positives that the labor market continues to heal.
So if the taper is delayed, it's not all bad news, and they're going to be slow to act, does this add to you? I know that you favor a short dollar position, but what's the driver of that short dollar position, Tim?
Sure. There's several factors. I would add that is added to the appeal as one of them, but of course that's not the only one for us. The dollar, in our view, still isn't that particularly inexpensive. It's still expensive actually versus a lot of emerging market currencies and a lot of developed market commodity currencies. So we think there's still good catch-up gains to be had on this cyclical upswing that we're in the midst of. U.S. rates are also appealing for foreign fixed income investors, but interestingly, they can hedge that fixed income exposure and get yield pickup if you're, say, a Eurozone investor or a Japanese investor even. Those inflows into U.S. fixed income to fund the U.S.'s deficits can be currency hedged. And so there's almost at worst, a currency neutral view from that perspective, and perhaps a currency negative view if investors continue to hedge their U.S. positions more. So all of those factors really add to the dollar short appeal.
Tim, yields seem to be, US yields, sovereign yields, seem to be range bound. Does that continue, or given the changing views on the taper now that's been pushed back maybe to November, maybe to December in terms of the announcement, where do you see yields going?
Yeah, I suspect a slow grind higher into year end. We're not. I think U.S. fixed income, for once, for me at least, is pretty boring for the next few months. I suspect you'll see leakage higher as normalization continues, and that's just the point. I think is this is a taper delayed, not a taper denied. Probably, you will get some sort of announcement, whether it's November or December. I don't really have a clear view on that. But the U.S. economy still remains relatively robust. Delta delaying the reopening and the continued normalization, but again, not denying it, I don't think. And so as a consequence, I see yields leaking a little bit higher over the course of this year.
Mr. Graff, you've written the 6:30 headline, a taper delayed, not denied. You've got a whole new future ahead of you if you ever choose. Stay with us. Don't hang up that Zoom. Stay with Tom and I. Tom, we've got a couple of lines coming from my part of the world here from Adnoc